World Cup kickoff, Tea Party defeat, less than expected US retail sales and the lowest unemployment rate in 5 years in the UK. But what do investors make of all this? David Keeble joins me down the line to try and decipher this week's main movers and shakers. David, it's been an interesting week on and off the pitch, so to speak, but what would you pick out as this week's biggest takeaway?
Yeah, for me, actually, it was the JOLTS survey that we got out early this week, Tuesday, really because this is something that Janet Yellen is looking at increasingly. She's mentioned a lot of the things that sit behind the headline JOLTS survey. And what it showed really was that we saw an enormous amount of new job openings coming through in April, just about 4.45 million, which was a big leap from what we saw in March. And actually, if you go back to before the crisis, this kind of number was completely normal. And now what it means is that for every 1.9 unemployed people, there's a job out there. So it's getting back to something resembling normality. I think that was the real story this week. And all the stuff that sits behind these sort of the headline job openings on the JOLTS was also sort of generally getting better. So it was really pointing to the fact that finally this US labour market is improving.
Perhaps one of the low points was the World Bank reducing this year's global GDP forecast to 2.8% from 3.2%. Now, this probably shouldn't have come as a surprise given the weather, but the World Bank also warned of a hard landing in China that could weigh down East Asian countries and hurt commodity exporters. Do you share these concerns?
I can't deny it's a risk, and it's been spoken about for so long now that you have to sort of realize that there are some big problems over in China, particularly in the housing market. But when you look at the Chinese government and the PBOC, what they do have is enormous flexibility, both on the fiscal side and also on the monetary side. And we all are aware that the Chinese have a different way of managing their economy from a pure capitalist standpoint. They do manage to give nudge and winks and push and pulls to various sectors of the economy. So, often when they do say that we're going to hit a certain growth number, they do hit it. And so I don't think there's really a big risk this year that they're going to go through a hard landing. And so for that reason, we're not quite in tune with the big downgrading growth that we saw, the 40 basis point drop that the World Bank was suggesting from 3.2 to 2.8. And if the Chinese don't slow, then East Asian countries, won't slow to the same extent either. So, bear in mind that the US is picking up nicely. Europe is also starting to grow, and it's got a little bit more monetary stimulation there from the ECB. We think that we're in a sort of generally a good growth environment globally now.
There wasn't a huge amount of data from the bloc after the ECB took policy into new negative realms last week, but this may be the calm before the storm, with European and German ZEW to be released. With that in mind, what is your outlook for the euro-dollar moving forward?
At the moment, I think we're all looking at the money markets, the reaction to what the ECB did last week. And we are, if you look this morning, finally on the euro-dollar, we're trading back almost to the post-ECB lows. And we think that we're going to be breaking down from here. If you look at 3-month Euribor, that's really dropped about 7 or 8 basis points, I think, really, since the ECB decided to implement all of these measures. If you look at the 2-year Schatz, it's only just above zero at 0.05. So there really isn't a lot of yield. So I think the euro really increasingly becomes the funding currency. And, even if we do get some growth, I don't think in the early stages in the next, quarter or so that's going to be faster than what we could be getting out from the States.
Next week, FOMC meeting may be the high point for markets. There has been the suggestion that the Fed may adopt a more hawkish tone or even accelerate the pace of tapering to $15 billion per month from $10 billion. Do you think this is on the cards, and what else should investors keep an eye out for?
The taper, I don't think, is going to be altered simply because the Fed has said that there's a high bar to doing almost anything on it, and so moving it from 10 to 15 at this juncture won't make sense. Maybe at the very last meeting of the taper, when they've got this $5 billion they don't know what to do with, then they might make a small adjustment there. But I think really for the Fed meeting next week, we've got to keep an eye on the forecasts. They produce these on a roughly quarterly basis. They're called the Summary of Economic Projections. There'll be a slight downgrade to growth because of the weather, and there'll be a slight upgrade, I guess, to some of the inflation numbers. But we all look at these things called the dot plots, which is where they give their view of where Fed funds rate will be at the end of end of this year and end of next year. And I think they'll be reaffirming what they told us 3 months ago. And if they do that, then I think we're in for a little bit of a sell-off in the front end of the Treasury market, because the front end really is a little bit lower than where the Fed says rates are going to be.
Well, viewers, that's all from David and myself for the moment. Don't forget, we also have Press Review today, and as it's Friday, Darren McDermott will be bringing this week's Community Stars, so make sure you click back for that. For now though, it's goodbye.